Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about one of my favorite topics, which is wash sales, the wash sale rule, some scenarios you might encounter with wash sales, and of course, how to avoid wash sales. Let's get right into it. So what is a wash sale? A wash sale is an investment transaction in which an investor sells a losing security to claim a capital loss, but within 30 days before or after the sale, repurchases it or a substantially identical security again. The clock for counting the 30 days begins the day after you purchase the stock, regardless of whether the next day is a weekday or weekend. The 30 days includes Saturdays and Sundays. Wash sales also apply to options, but I'll focus mainly on stock wash sales in this video. The wash sale rule, as stated by the IRS, is a regulation that prevents an investor from taking a tax deduction for a security sold in a wash sale. Since the loss is disallowed because of the wash sale rule, the investor has to add the loss to the cost of either existing shares or the new shares just purchased, which adds the loss to the cost basis of the shares either already owned or newly acquired to negate the effect of the loss. Why this was put into place was to prevent investors from intentionally taking tax losses on stock positions, buying the same stock again, and then realizing the tax loss by reducing capital gains. I want to explain that wash sales are not as relevant for someone investing long-term, since a long-term investor would likely not even encounter this issue and instead just focus on tax loss harvesting. Alternatively, a long-term investor might just average down and hold beyond the potential wash sale period. Wash sales apply more to the short-term investor looking to achieve an optimal purchase price for their stock positions. All examples I will mention are assuming trades are done in non-retirement accounts and with non-qualified money. Non-qualified money is recognized as income, and taxes will be paid on that money before they are contributed to the account. These investments are made with after-tax money. Qualified money refers to money invested into retirement accounts that have some sort of tax benefit. Qualified money typically grows tax deferred until it is withdrawn and recognized as income. Before I give any examples of wash sales, it's helpful to understand what averaging down is first. They typically go hand in hand with wash sales, since averaging down may happen before a wash sale comes into play. Averaging down is an investing strategy in which an investor purchases additional shares of a previously initiated investment after the price has dropped further. The result of this second purchase is a decrease in the average price at which the investor purchased the stock. Assuming no fundamental analysis or technical analysis in the consideration of this example to illustrate what averaging down is. If an investor buys a security like Procter & Gamble that makes all kinds of consumer goods that you likely have in your household, and you buy 100 shares at today's price of $135, if for whatever reason the stock market is down one day and Procter & Gamble gets dragged down with it, the price drops a few dollars down to $127, and that investor decides to buy another 100 shares. This is called averaging down. The investor would own 100 shares of Procter & Gamble at $135 and another 100 shares at $127. The investor's average cost basis becomes $131 per share that they own because they averaged down by buying the second bunch of 100 shares. Now that I've gone over averaging down, I can explain some examples of where a wash sale may come into play. To preface, if you make a trade and sell it in the money at a profit, there is no wash sale. The examples I'm going over will focus on taking losses on out-of-the-money trades to avoid a wash sale and what happens once a wash sale occurs. For the first example, if I simply just want to take a loss on a stock, I buy the stock and sell it at a lower price. Assume I buy 100 shares of Procter & Gamble at $135 on August 3rd and sell it at $127 out of the money on August 7th. I would lose $800 by choosing to take the loss. Then I just don't buy Procter & Gamble back for 30 days. On day 31, which is September 7th, I can choose to either buy it back if I like the price at that point, or choose to move on to a different stock. The second example, I'll go back to the example I mentioned to illustrate averaging down, Let's say I bought 100 shares of Procter & Gamble at $135 on August 3rd, and then another 100 shares at $127 on August 7th. Assuming the share price continues to go down to say $122 on August 10th, and I want to move on to something else by selling one bunch of the shares. The 30-day clock starts from August 8th, that being day 1. I have a choice of selling either bunch of the 100 shares or any other odd increment if I choose. For simplicity, let's say I choose to take a loss on the 100 shares at $135 and sell it at $122 on August 10th. For a wash sale, which is within 30 days of buying the most recent bunch of shares from August 7th. That means I add $1,300 to my cost basis of $12,700 on the second bunch of shares, which becomes $14,000 because of the wash sale from August 10th. The third example, using the same 2 stock purchases from August 3rd and August 7th, assuming by August 15th or so that the price of Procter & Gamble has not increased and just stayed around $125. If I wait 30 days from August 7th, which is September 7th, I would have the ability to sell either bunch of shares at a loss without triggering a wash sale. By waiting out the 30 days before taking a loss, a wash sale is avoided as long as another purchase of Procter & Gamble is not made within 30 days of taking the loss. The fourth example, going back to the same example of your 2 bunches of shares of Procter & Gamble on August 3rd and August 7th, assume one bunch of shares are in the money and one bunch is out of the money, and I want to take a loss on the out of the money shares. That would mean the current stock price of Procter & Gamble moved up since August 7th to $130. If I sell both bunches of shares with 100 shares at $127 being at a profit in the money, and 100 shares at $135 at a loss out of the money, then I can sell at any time with no wash sale. As long as I don't buy any more shares of Procter & Gamble within 30 days of selling both bunches of shares, the wash sale would be avoided and a loss can be taken on the initial shares. Extending this fourth example, if any additional stock purchases of Procter & Gamble happen before or after September 7th, the 30-day clock would begin again. If this were to be repeated, the clock would keep restarting until either a wash sale occurs or until 30 days is waited out from the most recent purchase to be able to take a loss on the shares that were sold. The fifth example is almost identical to the first example, except with any number of bunches of shares. It could be 2 bunches or 3 bunches of 100 shares of Procter & Gamble. If I own 300 shares of Procter & Gamble purchased on 3 different days and prices, I sell them all at the same time, I can take the loss on those shares as long as I don't buy any shares of Procter & Gamble back within 30 days. When selling all bunches at a loss, you avoid a wash sale and the 30-day clock starts from the day after selling at a loss. Most of the examples, except for the second example, are around avoiding a wash sale and just taking a loss on a losing trade by waiting 30 days. The second example of moving the cost basis onto existing shares is what happens when a loss is not allowed due to the wash sale rule being triggered within the 30-day wash sale period. When selling at a loss, you can't buy back the same stock for 30 days. When buying a stock that you already own, you restart the 30-day clock. To summarize, the first example is just taking a loss on a stock. The second example is moving the wash sale onto one of your other bunches of shares. Both bunches are out of the money. The third example is owning 2 bunches of shares and wanting to take a loss on one bunch of the shares without a wash sale. The fourth example is 2 bunches of shares, one in the money and one out of the money. You can sell both at the same time without a wash sale. The fifth example is if you own 2 or more bunches of shares and you want to take the loss on all of the shares to avoid the wash sale. These examples could be somewhat common scenarios if you have just started trading frequently. There usually is a W or a circle or square with a W next to the shares of what stock the wash sale has occurred on or cost basis has been added to when looking at your brokerage account. So why would someone want to take a loss or create a wash sale if it wasn't done by accident? Price optimization. By taking a wash sale and adding the hopefully minimal loss onto a new or existing cost basis, you hope to buy the same stock back at an even lower price. Margin interest. Margin interest is accruing and it's hard to sit on losing trades while paying interest on them. Lost interest in the stock. Change your mind about how you feel about a stock. Maybe there was news that adversely impacts that company and you want to move on to something else. The most common reason is probably for price optimization, somewhat predicting that the price of a stock may continue to go down before it increases again. Likely you may have already averaged down and taken a small wash sale on one bunch of shares and getting ready to buy it back lower. Margin interest and losing interest in the stock can be closely related. Losing interest in a stock could be due to some bad news coming out for it, or could be that you're paying margin interest for borrowing money to buy the stock and it's out of the money for too long. When trading on margin, if something is at a loss and you are also paying interest, you are effectively compounding the issue. Often, I'd think that margin interest would be a decent reason to consider taking a loss or a wash sale on a stock temporarily so that you're at least not paying interest on a losing trade for too long. Losing interest in a stock could be also due to how long you held the stock as well. If you think it's an extremely long time and the stock has not increased as you expected it might. As a short-term investor, you might think that it's time to move on to something else potentially. Something to keep in mind as you invest to determine whether you are trading or investing, depending on if you are a long-term investor or short-term investor. If timing matters, then you are trading. A long-term investor thinks less about timing than a short-term investor. So as you are investing, think about if timing matters to you before you buy. Also, for your specific investments, portfolio and stock trades, consult an accountant and CPA for trading scenarios that may impact you and your taxes. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments and questions and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.